It's time for In the Money, stock market action on AMA 20 News. Here's Chief Market Strategist Gareth Soloway from InTheMoneyStocks.com.
Good afternoon, everybody. Hope everyone's doing well today on this Sunday, March 30th, 2014. My name is Gareth Soloway, Chief Market Strategist at InTheMoneyStocks.com. All right, lots to talk about today on the show. We're going to go over the market action last week. And remember, folks, I'm here to give you the honest base truth about the markets, not the nonsense spewed by the investing public, the financial shows out there that will talk about, oh, it was this news break or that news break that drove the markets, because that's nonsense. And ultimately what they do is hype the markets in one direction, putting you in harm's way as you get caught up in that hype emotionally. So we want to make sure we keep an even keel, keep emotion out of investing and trading, and that's how you will make millions, if not billions of dollars over the course of your life. All right, so on today's show, we're going to talk about some major things out there. First, what happened last week? What were the driving forces? We're going to go over the trade alerts I gave out last week and what a monster makers they were. I mean, just huge, huge winners. It's funny because a couple of them were basically on the flat line. We saw actually 3 of the 5 really around the flat side, but 2 of them made over 10% in 5 trading days. From Monday to this past Friday, over 10% gain on just 2 of those plays. And that is epic, folks. I think that kind of caps the end of the quarter in a great way for those of you that have been following the trade alerts. One of them was Facebook, which I said to continue to short. We've been bearish on Facebook for quite some time, and that stock absolutely got annihilated this past week. We're going to talk a little bit about why and when does it become a great buying opportunity, because, I mean, every stock that gets punished at some point will have a bounce, and I want us to capture that bounce. I love the idea of making money on both sides of the market. That's what every investor listening should be thinking of doing. All right, when the stocks or the market goes down, you make money. When it goes back up, you make money. And you just need to know at what price point it becomes a buy versus a short or a sell. Now, remember, shorting is something that you need to start to do. All right, it's a way of basically betting when the market goes down. Very simply, you go into your investment account, Scottrade, E-Trade, whichever ones you guys have, and you'll see a button there that says short. And that's how you do it. You just click that button instead of the buy button, and all of a sudden now you're positioned to make money when that stock or equity goes lower. And again, this is something that the big boys have done for ages. This is something going back, I mean, hundreds of years that's been done. And you have to be able to do it. I mean, the investing public has generally been taught that this is not good. And the reason why the investing public's been taught that is because the big boys don't want you to do that. The big boys, the institutions, the big banks, hedge funds out there, they want to be the only ones making money on the way down, right? Because ultimately they need bag holders. They need someone who bought the stock high and is basically losing out. Remember, for every buyer in a market, there has to be a seller. So if everyone was shorting the market together, then the institutions couldn't make massive amounts of money, right? They ultimately need you emotionally to be bullish at the highs and be buying at the highs so that they can position themselves on the opposite side of you. And ultimately at the lows, they need you positioning yourself on the sell side or getting panicky and selling all your positions so they can be the buyers. And they accumulate just like they did in 2009 at the dead lows in March, and they ride the market up. And then I've been saying it since this show debuted in early January 2014 that they've been distributing. And we see more and more signs of that, more and more cracks in the glass and the ice as this market gets ready to continue its downward move. Last week, we saw major declines in certain sectors. And these sectors I had actually come out and said basically a month ago were in bubble territory. All right, one sector was the biotech sector. All right, biotech sector, if you look at the IBB chart, which is the ETF that tracks the biotechs, it hit a high recently, about 3 to 4 weeks ago, of $275 per share, and that's per share of that ETF. That ETF drops and has dropped down to the 220 area. All right, it's actually getting near an area where you want to start to get invested and get on the long side, and I'll talk about that as a level when we go into the trade alerts for this coming week. But again, remember, the quarter has come to a close. That means I am now, and this will happen next week, going to be donating for every loser I called. I will be donating $100. and I have all the numbers here for the quarter for you. And remember, I've given out a ton of winners and big winners. I would say the average weekly gain, if you average it out from my 5 plays that I've given, probably you made about 2.5% per week. Think about that gain, folks, over 52 weeks a year. Well over 100% return if you were just staying with the plays and kind of evening out your money over those plays. In addition, J.C. Penney, which was a play given out at the beginning of the quarter, early in the quarter got decimated, came back strong, and basically closed at the highs of the quarter in this past session or these past few sessions. So nice move on J.C. Penney coming back. But check this out. This is what I gave you guys. Ultimately, approximately 5 plays every week. All right? 5 plays every week approximately. That's basically 60 trades for the quarter. We had about 10 losers and 5 flat trades. And then ultimately, think about that average. Right? Out of 60 plays, 10 losers, that's about 80+% gain with the 5 flats as well, and averaging about 2 to 2.5% a week if you average it all out. So that gives you, again, over 100% a year. I'm going to take all my losers and flat plays, and in addition, I matched someone who called in earlier this quarter on the money that they donated to charity for making money off of my plays, and that comes out to be $1,950 going to Metropolitan Ministries. I encourage you guys to donate a little bit at the end of the quarter with me. Let's make this a momentum movement. Let's help this charity, and next quarter we'll be looking to help a new charity. So I'm going to round it up to an even $2,000, and I will be going this week to Metropolitan Ministries and handing them a check. I will also have them on the radio next week to talk a little bit about what they do and how they help people. Okay, let's go into a couple other things, folks. Let's talk a little bit more about the markets this past week. I think that's the important factor. And every time I go over the action in the previous week, I need you guys absorbing it because I'm giving you the base levels, the base technicals of what's going on in the market, and I need you to start to understand so you can read the market in the future. All right, I hope I do this show for years and years and years and years, but ultimately at some point I won't be, and I need you guys to be at that point where you're saying, I can do this on my own. I can be that best investor and that top 1% of investors in the entire world and just continue to print money week after week. So ultimately, we discussed the IBB, the biotech sector. That broke down. Technology broke down. The key to the breakdown in these sectors, and listen, the Dow and the S&P held up pretty well. The Dow and the S&P held up really well, and there was a major rotation of capital, which I'm going to discuss in a minute, which you need to be aware of because it's the interim level between a top and a kind of a little start to the pullback before the bigger pullback. And again, once I explain the rotation of capital, you're going to see it very clearly. But going back, we have to remember how this market has set up. If you recall, 3 Thursdays ago, and I've talked about it every weekend since in this show, in the Money Stock Market Action, we've seen that 3 Thursdays ago period, that big reversal followed by a Friday confirmation move to the downside. What's confirmation? Just to refresh. Confirmation is where this market has a big sell-off day, and then the next day you have another sell-off where the close of that day is below the previous day's low. So Thursday, let's say, made a low. It started at $20. We're just going to use arbitrary numbers here. Starts at $20, sells off to $10. The next day, it closes below $10. That's confirmation. That tells you there's a change in trend. And what was so amazing about this is the market kept on bouncing back up over and over again, right to the high, that $20 mark, okay? And it never could bust through and close above that level. And that continues to just be a very clear signal. I mean, it doesn't even take a brain surgeon to see this type of thing. Just very simple, like, oh, okay, well, can't get through that level. So I guess that tells us that we should continue to be on the bearish side. And ultimately, we saw the markets continue to collapse down, especially in the Russell 2000, the tech sector, the biotech sector, and those are the highest risk plays, which brings me into this rotation of capital. So that's what's been going on. This last week, these last really 2 weeks, you've seen the NASDAQ getting crushed, and the Dow's been staying pretty stationary. So why? I mean, why have we been seeing certain stocks getting taken out to the woodshed and just hammered while we've been seeing other stocks holding up pretty well, like IBM, for instance? IBM, the last few days of the week, this week kind of fell back down, but for the most part, I mean, it had some days where the NASDAQ was down huge and IBM was up $6 one day. So why is that happening? And that's called a rotation of capital. And what you're seeing here is a major de-risking of trades. So the average investor, the institutions, they don't want to be in a high-risk environment right now. So they're pulling money out of biotechs, which have been in a bubble. They're pulling money out of the big tech plays like Priceline, Netflix, Tesla, all these high-flying stocks that are up hundreds of percentage points in the last year or so. And that money isn't getting pulled 100% out of the market. What's happening is it's going into the lower risk dividend paying stocks. The IBMs, the Hewlett-Packards, DuPonts haven't really, DD symbol there. That hasn't really fallen much, although I think it is getting ready to fall based on the chart pattern. So that's what's happening. It's a rotation of capital, a rotation of money from higher risk plays. They're not pulling it out of the market yet. They're just rotating in the safer plays that they think, okay, well, I'll be safe here because at least I'm getting paid a dividend every year. At least, these stocks have been around since forever. If you look at how long IBM's been around, for instance, it's decades, as opposed to, a Priceline. Priceline's been around a lot less. Netflix, same thing. Okay, so that's really what's going on here, and that's the interim level, right? If you look at a market and you look at the periods of a market, you have the major bull side, and then when you come up to the top, what happens? At the top, everyone's just throwing money recklessly at the markets. The average investor, I've talked about this day in, day out, throwing money at the market, and just, they don't care. They don't care where they're buying a stock. And it drives me nuts that they don't care, but that's the mentality. They're thinking, oh, I can make money anywhere in this market, so let me just throw it all in the market. And let me put it in the highest risk plays, the Teslas, the Netflix, the Pricelines, because that's the place that it's been going up the most, I want to make some of that. But they're buying at all-time highs on these things. They're buying at levels where the institutions are thanking them for buying because they're selling right to them. And guess what happens? If you look at the charts of Tesla's down from like $275 to almost $200 a share. These are huge drops. If you were someone who bought it up near those highs, you're down, 20, 30% in a matter of a month or two. You can't be doing that, guys. You can't be chasing stocks. And it's the old adage, and I'll wind up before we head to commercial here. But you have to remember, treat stocks like you're going to the shopping center, the mall. When you go in, let's say I want to buy a pair of jeans. I don't rush into the mall and into JCPenney, Macy's, wherever I'm buying my jeans, and I don't look for the sign above the jeans that says marked up 200%, buy me now. And I don't run over and say, oh, yeah, this is up 200%. This is the best deal on earth. No way, that's crazy. You'd never do that. Instead, I look and I say, all right, these are some nice jeans, and they're marked down 50%. I think I'll take those. That's the mentality you need to have. So we're going to go into break here. I'm going to come back and discuss more about how to make sure you're on the right side of this market. My name again, Gareth Soloway, Chief Market Strategist at InTheMoneyStocks.com. And this is In the Money Stock Market Action on 820 AM News Talk Radio.
Now back to In the Money Stock Market Action on AM 820 News. Here's Gareth Soloway.
Welcome back, everybody. Great to be with you here on this Sunday, March 30th, 2014. Stocks have come to the end of the first quarter, and that means next month, or in this coming month of April, we'll start to get some earnings announcements, which should make for some volatile action. And I'm excited about that because as a trader and a swing trader, it really gives us opportunities to get even more profitable trades in the book. Volatility is my friend. I love a stock market that goes up and then down and then up and then down because it gives us the ability to be buying at the lows and just selling at the highs a few days later. One of the trades I took this past week was a long on Priceline. Okay, there was a key level it came down to. I bought, I think it was on Thursday, we bought as all the members here at InTheMoneyStocks.com. And by the way, there's a free trial for that. So if you want to get in on it, the research center at In the Money Stocks is meant for swing traders and investors. So if you're someone who works all day, that's really where you want to be. If you're a day trader, we have an intraday stock chat that I run with my business partner as well all day long. But again, most of you will fall into that research center, and there is a 7-day free trial for that. But in any case, Priceline was getting crushed down from something like the $1,375 range, fell all the way to about the $11.60 level. We bought at $11.59, and 1 day later we sold at $12.10. Think about that. 1 day, $51 per share gain on Priceline. And I just read the charts very simply. It was a gap window, which is a technical term on the charts. I'm not going to get into that today, but it was an obvious no-brainer And just like that, almost a 5% gain in one day on one stock. And once you learn this stuff, it just becomes, it's so empowering. You don't have to worry about the bullies on Wall Street anymore. You don't have to worry about the market taking your money. You know, you're always going to have a loser here and there, but the discipline and the constant profits put you in a position to make money for life. And again, I can't stress that enough, how I think personally long-term investing's dead, because the high-frequency trading programs, the big boys, they're going to continue to create bubbles, especially the Federal Reserve, and they're just going to collapse them. So if you're just a dollar cost averager and you're buying, sure, you're going to make money on the upswing, and then when the collapse comes, you're going to give a majority of it back, and then you'll make it again on the upswing and give a majority back. Instead, buy low, take your profits high, wait for the pullback, wait for the drop, wait for the collapse, buy again, and rinse and repeat. All right, and again, we're going to, in just a few minutes, we're going to listen to Jim Rogers. I'm joined by him today, truly an epic investor, businessman, one of the best-known names in the financial industry. We'll be hearing from in just a little bit. And again, Jim Rogers, kind enough to be with us. I had such a great time talking to him last week, and you'll hear that interview shortly. Just a class act all the way around. Really amazing to hear his perspectives on the market, on the Federal Reserve, what he thinks is coming. And this has been the biggest name out there, folks. You're not going to get any bigger than Jim Rogers. So we'll listen to that in a little while in the second half of the show, and I'll follow it up with some Q&A if we have a little time at the end of the show. But a couple other things I want to go over here. All right, number one, I want to talk a little bit about how we're going to do the next quarter for charity. All right, I'm still up in the air. So what we're going to do here, I'm going to give you some trade alerts in the coming minutes now for next week. But what I'm going to do is I'm debating on how I want to structure it. I kind of want to change it up every quarter to give it a different look. And I'm leaning right now towards having an account maybe with 50,000 or 100,000 in it, and I'm going to trade that account, and 10% of that will go to charity in the coming quarter. I'm not solidified on that just yet. If anyone has any suggestions, I'd be more than willing to hear them. But right now, I think I want to change it up. Now, I'll still give out trade alerts during the show, but we'll change it up, and I'm going to see how much money I can make for charity in my account. I think that'd be a fun thing, you know. And I'm thinking about maybe half and half, if 50,000 day trading, 50,000 swing trading, you know, do something like that to really see how much money I can generate going hardcore. And maybe I can make, you know, 20, 30, 40, 50,000 in a quarter. I mean, anything's possible, I guess. I mean, that would be pretty amazing on a 100,000 account to make, you know, even 20,000 would be pretty miraculous for one quarter, a 20% return. But I think that'd be fun for you as listeners to kind of hear how much money is possible in real life terms, right? But I still am going to give out trade alerts, and I still want you guys, as you're making money on the alerts, to give to charity as well. Just give a small amount. It's karma. It comes back around tenfold, and I'm proof of that here as I continue to trade very well, as I'm giving money every week to charity based on my losers out there. All right, so we went over for the quarter what things did, and I just want to go over the charts, the trades from last week. I gave long SDS at $28.62. It closed at $28.83. That's a 21-cent gain, or a 0.7% profit. So really, that's almost a flat. I'd call anything less than 1% up or down as a flat. Hewlett-Packard was flat as well. UNH was flat as well. So basically, 3 trades I gave out last week were basically flat. No gains, really, no losses. If you take the 1 winner and the 2 small losers there, you actually come out with a small gain from those 3. The big names were TZA. I said long TZA at $14.93. It closed at $16.49. That's a gain of $1.55, or 10.4%. So in 1 week, 5 trading days, 10.4% gain, and the short on Facebook was the rock star. All right, shorted Facebook based on that previous Friday close, 67.24. We've been short it the previous week as well. It closed at $60.01. That's a $7.23 gain, or 10.75%. Awesome gains there. All right, let's get into the action here, guys, on the coming alerts. I have 3 alerts this week. I'm not going to always give out 5 because we're going to be changing up the mentality, but I'm giving you GLD long 124.56. That's gold. I think gold bounces this week. I liked how it traded on Friday. So again, long on GLD, which is the ETF for gold, at $124.56. We're going to stick with SDS, which is 2 times short the S&P 500. You're going to go long SDS to gain that advantage on the short side. And again, that's long SDS at $28.83. And DuPont, we're going to short. I like the bearish pattern formation on DuPont. and that's a short at $62.62. Excuse me, $66.62. That's where it closed on Friday. So GLD long, SDS long, and short DD. Now, I have a couple stocks for you guys to watch if they hit major levels this week for longs on the chart. All right, if Facebook, and this is where I love it, because this is where if we get enough of a flush on Facebook this week, you can go long on it, $53.50. So it still has to drop about $6.50. If it gets flushed this week to $53.50, you can initiate a long there. That is a major gap fill, a major level. Price line, if it gets to $1,095 at a current price of $1,192, so it has to drop a little less than $100, which is about an 8-9% drop. If it does that, buy at $1,095, a major support there. A lot of these are 200 moving averages with gap fills as well. And IBB, I talked about the biotech index. This is the one that's probably closest percentage-wise to its target for a long. It's been the one that's been crushed the most. And again, while the average investor probably is getting scared of the biotechs, oh, they're falling, this is where we as gutsy pro traders with no emotion, we look at the chart, we step up, we make money. IBB can be a long at $215. If it flushes this week, which is about a $15 flush to 215, closed at 229, that is your entry. So a long on IBB at that level. You don't want to buy before, in my opinion, and if they don't hit, who cares? There's always another trade around the corner. But again, those are the good levels to go by there. All right, folks, so that's some interesting thing. The last thing I want to talk about before we take a short break here is just high-frequency trading. Tonight on 60 Minutes, Michael Lewis is going to talk about how Wall Street basically has the game and they're playing against you. And I want you to understand that, folks, because I recommend people checking out 60 Minutes tonight because of this. He basically talks about how the high-frequency trading programs get you on the opposite side of the market instead of being on the right side, because they basically play with your emotions and push things into levels or into ranges where you're going to be bullish when you should be bearish. This is what I've been speaking about for ages. This is what I've been talking about for ages. So he's going to talk about it. But the one thing I want you to understand before we go to break here, one thing that I need you to understand, doesn't mean you can't make money off of it. You need to just learn it. I don't want you to watch this and get scared and say, I'm never going to invest again. I want you to say, I'm going to learn how to make money off of this. All right, guys, we're going to take a short break, come back with Jim Rogers. I will talk to you soon. Take care.
Here's Gareth Soloway with more In the Money, stock market action on AM 820 News.
All right, guys, back here with you, second half of the show today. We're going to get right into this interview with Jim Rogers. His analysis, his guidance, his viewpoints are unbelievably important for all of us to keep in mind. And again, just a great interview, great sit down with him this past week. So without further delay, let's get right into that interview here on 820 AM News Talk Radio. Today, folks, we are excited and honored to welcome a great American businessman, legendary investor, and author to In the Money Stock Market Action on 820 AM News Talk Radio. It is my pleasure to welcome Jim Rogers to the show today. How are you doing, Jim?
Oh, I'm delighted. I'm delighted to be here, Gareth.
Thank you again for joining us.
It's my pleasure.
All right, so I always was curious about one thing. You know, you're such an idol to many of us who are investors and trying to become greater investors. You know, how did you get into this whole investing realm?
Well, it's a very good question. I actually, when I was a senior at university, I was going to go to law school and business school and medical school. I was a confused young man, obviously, and I stumbled into a summer job on Wall Street just because I liked the guy interviewing it, like me. I knew nothing about Wall Street, but I didn't know there was a difference in stocks and bonds. I was totally naive. I just went down because I liked the guy. But, Gareth, I immediately fell in love and tried to predict the future of the world, and that was my passion. I couldn't believe it. I couldn't believe these guys would pay me to do this. So I didn't go to law school or business school or medical school. I went to Wall Street and never looked back.
Wow, that's amazing. That is amazing. I read that your quantum fund, when you had it, made 4,200%, while the S&P 500 only advanced about 47% over that entire time. How did you decide on your investments? Do you do like a lot of research? Was it just more of a natural ability you had to find these investments?
Oh gosh, I wish I had a natural ability to do anything. Wouldn't it be wonderful? It all happened because of enormous amounts of research. As I say, I was consumed by the world. Still, fortunately or unfortunately, that was my passion. And so I was constantly reading, researching, getting on airplanes, flying around, doing whatever it took in order to find out what was going on in the world. We're looking back on things that nobody was paying attention to, especially things that were depressed, where there was possible change coming. Because if you can find things that are depressed and therefore cheap, where there's good changes taking place, gosh, you can make a lot of money.
Oh, interesting. So would you say that you're big on kind of the contrarian point of view where, when everyone else is fearful and hates something, that's where you start to kind of scope it out a little bit for potential investment?
Well, yes, as people call me a contrarian now. I didn't really know those things back in those days. I was so naive. Yes, but by definition, Gareth, if something is cheap and ignored, it means nobody's interested. But I don't buy something just because something is cheap and ignored. There has to be more to it than that in order to have a successful investment. You must find something where there's something changing, something positive changing in order to make money.
Absolutely. That's a great point for our listeners to hear. Now, just something that I had a personal question on. Do you happen to remember your best and your worst trade in your career?
We could spend 2 or 3, not just 2 or 3 radio shows, 2 or 3 lives talking about my mistakes. I assure you. My best, I guess, was my children. I never wanted to have children. I thought children were a horrible waste of time and energy and money, and I want you to know I was totally 100% wrong about that. I didn't have my first child until I was 60, but boy, this is so much fun for me. I cannot get enough of these 2 little girls. If there's anybody listening who hasn't done it, I urge them to get home and get on with it, because I'm telling you, it is a lot of fun. It changed my life. It changed everybody's life. So please make sure you don't miss it.
That's amazing, and it's a nice little break from kind of constant focus on investments. I'm glad you said that. That's great.
Well, for me, it's amazing. It teaches me a lot about life, about myself. Which, if you're going to be a good investor, you certainly need to know as much about life as you can, and about the world if you're going to be successful. So, I'm very keen. I'm very pleased that I did it, and it's certainly my best investment. These girls got to take care of me someday.
Yeah, my parents have said the same thing, so and I look forward to any help I can give my parents for sure. Do you have any views on China and the South American markets right now? We know that they've been hammered lately. Everyone's kind of very bearish on them. Do you think that there's more downside there, or are they getting to a point where they look attractive?
Well, I do have views. For instance, I moved to Asia because my children speak fluent Mandarin, and both of them speak Mandarin like natives. In my view, Mandarin is going to be the most important language in their lifetime, and so I'm preparing them for what I hope is the 21st century to give them a major leg up. Just because they speak Mandarin like natives will not make them successful, I assure you, but we hope that at least if they're working in a restaurant, they'll be the maitre d' instead of the dishwasher. Moved to Asia because of China. That does not mean there won't be many problems in China along the way. As you know, Gareth, we in the U.S. had many problems as we rose to become the most successful country in the 20th century. We had a horrible civil war. We had 15 depressions with a D. We had very few human rights. We had massacres in the streets. We had little rule of law. I mean, you could be able to buy and sell congressmen. Well, you can still buy and sell congressmen, as you know, but in the old days, cheap. You could buy 3 or 4 for the price of 1. But out of all of that mess, America became the most successful country in the 20th century. China's going to have many problems along the way, the property bubble, which they're trying to pop and do something about. You're going to see some people going bankrupt in China. But that's the way the system works. That's the way capitalism works. It's only in America that people are not allowed to fail. In China, they let you fail. And I wish we let people fail in America.
There you go. Yeah, failure is part of success. One of the best ways to learn how to succeed, I suppose, is by failing multiple times.
Well, I certainly learned that.
Yeah.
Plenty of money.
Well, you're very, very humble, and it's inspiring. And again, thank you for being with us. We're talking to Jim Rogers today. And my next question was, are there other signals, or what would you say are the most important signals that the average investor should pay attention to when looking for a good investment? I mean, there's so much hype in the media on the financial stations. It usually seems to get investors on the wrong side of the trade. Are there things that you would suggest the average people looking at to be on the right side?
My experience is that for most investors, they really should only invest in what they themselves know a lot about. Now, everybody listening to this knows a lot about something, whether it's fashion or cars or who knows what. Everybody listening to this spends a lot of time reading magazines about something or watching TV shows about something. Their spare time, they're doing something. That's where they should start, because they already know more about things than I do, that Wall Street does. And if you find things where you already have your own passion and interest, you're ahead of the rest of us. And when you find something, a major change coming, you're going to see it before I am, before anybody else does, and then start doing more homework about the company, about the change, and that's how you make money. You'll buy it long before I will. You'll know when to sell it long before I will. That's how people make money. Everybody wants a hot tip. Everybody wants to jump into something. But that's no good, at least in my experience. The way to make money is stay with what you know. You don't need many great ideas in order to be successful. If you have 25 ideas in your life that work, and most of them work, you're going to be a lot more successful than nearly everybody you know. Stay with what you know. Stay with what you're doing anyway. That's how you'll get rich.
I had a question about the stock market. I mean, we've seen the stock market since the lows in 2007 up 150%, just last year up 30%. I mean, as an average investor listening out there, are you thinking that there's more upside? Are we getting near another big collapse? I mean, do you have any views on that?
Well, I'm a little bit skeptical about the U.S. stock market, mainly because of most stock markets. Mainly because, what's happening is for the first time in recorded history, we have all major central banks around the world printing huge amounts of money. The Japanese said they would print unlimited amounts of money. That's their word. The Europeans said we will do whatever it takes. That's the quote. So America jumped in, started spending $1 trillion a year, pumping money into the economy. The English jumped in. So this has never happened. So we're all living in an artificial ocean of liquidity, which has been rising pretty dramatically for several years. In my view, well, I know it's artificial. In my view, it's a terrible mistake, because when this ocean dries up, we're all going to suffer and suffer badly. Now, the bureaucrats in Washington say differently, and bureaucrats everywhere say differently, but, that's why they work for the government, yeah. They couldn't get a real job. So they sit down there and they talk to each other with these strange theories. They're going to make us all suffer in the end. Now, the people who are getting the money now are having a wonderful, wonderful time. But it cannot last, and eventually we're all going to suffer.
Yeah, and I think it's kind of interesting to note also, how the stock market has had a great run, but the major beneficiaries of that are the wealthier individuals who have a lot of investment in the market. If you're on the poorer side, it's a lot harder to make money over the market's rise. So kind of interesting just to note that. And, we talk about this divergence in the middle class shrinking and the poor and the wealthy gap rising. And it's got to be a major player there with the stock market up so much. It's helping one end of the spectrum and not everyone.
Oh, you're right. As I said, the people getting the money, whether it's in the stock market or elsewhere, banks, financial institutions, are having a wonderful time. But the fundamentals have not gotten better. As you know, unemployment is higher now than it was in 2008, and that's around the world. Debt on higher and higher and higher. It's inconceivable to me that the way to solve a problem of too much debt is more debt. But that's what they say. That's what grown-ups in Washington say. It's staggering to me that people could say that with a straight face. All we got to do is build up more debt, borrow more money, and spend more money, and everything will be okay. But that's the approach, and in my view, it's not going to work.
Yeah, absolutely. Now, your take on the Federal Reserve. To me, the Federal Reserve, if you go back to Greenspan, it just continues to build these bubbles, and ultimately we all pay the price for them, just like you were mentioning. I mean, are you looking at Greenspan and the Fed as having caused the financial collapse initially in 2007 and the real estate bubble?
That's what happened. I mean, anybody who says it's not what happened is to go back to some homework. You read all the things that Mr. Greenspan, the Federal Reserve, was saying. And Mr. Greenspan was saying everybody should go out and take a floating rate mortgage. Everybody should buy their own home, et cetera, et cetera. I have nothing against owning your own home, but I certainly have something against, buying 3 or 4 houses with no down payment and no job, which a lot of people were doing. It was madness. It is madness. Federal Reserve won't say that they caused it, but if you go back and read their minutes, I mean, at one point there was a major paper done at the Federal Reserve by the chief economist who started out by saying, there are people out there who say that housing is a problem and that we're all going to suffer. But how can they say that? We have 1,000 of the best economists, PhD economists in the whole world working here, and we know there's not going to be a problem. And they put this in writing. They really believed that they knew what they were doing, and they kept pumping money into the system, into housing. They weren't regulating. In theory, the Federal Reserve is supposed to regulate the banking system in the United States. Well, that's where the problems erupted. Problems erupted in banking, insurance, and Fannie Mae and Freddie Mac. And those are 3 of the most regulated industries in the United States. And yet the Federal Reserve, who was responsible, directly or indirectly, for those industries, said there's no problem, and kept pumping money into those industries. I don't know how anybody can. I mean, I guess people can say anything they want, but the problem came from Greenspan and the Federal Reserve. There are those of us who wrote it down and said it at the time that this was going to be a disaster. And, of course, when it did become a disaster, they all said they got lucky. They didn't know what they were talking about. Nobody could foresee it. I mean, this came from the central banks, just like the next problem is going to come from the central bank. And it's going to be a big, big mess, Gary. You should be worried. You should be prepared. And you should be looking around.
So now, speaking of that, where would you suggest the average investor kind of looks? Like, I mean, if you've got a 401k or if you've got an investment account, where would be that area that you would suggest kind of taking a look at for a good investment when things go south?
Well, first of all, people should learn how to sell short, which is a way to make money if things do decline. That's not for everybody, and if you don't want to do it, then please don't. That's like, don't listen to me. But say, look in the areas you know a lot about. I, for instance, mentioned earlier, I'm not too keen on stocks in the U.S. because the U.S. stock market is near its all-time high. I'd rather look around the world at stock markets that aren't at all-time highs. There are markets that are low. There are things happening in China where the market's down to 70%. There's good and bad things happening in China. In Japan, there are good and bad things happening. The market's down 60 or 70% from its all-time high. So there are places to look. In my view, agriculture is very depressed, extremely depressed. So I'm looking for investments in agriculture where I might see things getting better. But I don't like to jump on a moving train, and U.S. stocks are, as I say, at all-time highs because of all this artificial money printing, and I'm worried about how it's going to end. I'm not so sure it's going to end badly this week. By any stretch, don't think I'm sitting here saying, oh, my God, look out the window and jump out the window. No. I'm not saying that at all. But I do know that when this ends, it's going to be a problem for all of us. So when the next economic slowdown comes, and it will come, it's going to be a huge disaster because you've had all this debt which is built up. 2007 and 8 was much worse than the setback in 2001 and 2, which the debt was so much higher. My goodness, Gareth, this time the debt is multiple times higher. I don't see how we can get out without a big problem. We've had economic problems every 4 to 6 years since the beginning of time. I don't see anything that's going to stop that. We all haven't suddenly learned some kind of genius. People in Washington certainly don't know what they're doing, in my view. So we're going to have a new problem someday, and when that new problem comes, it's got to be worse because the debt is so much higher. I mean, it's staggering how much debt they've incurred. The Federal Reserve alone has quadrupled its balance sheet in just 5 years. I mean, these numbers are staggering. And yet in Washington, they say, don't worry, trust us.
Yeah, exactly. No, I'm in your camp 100%. Over the last month or so, I've been encouraging our listeners to kind of move into cash and take profits on this market, because I agree with you. It's just the writing's on the wall, and it's just a matter of time. I saw a panel with Ron Paul and you discussing how the Federal Reserve should be abolished. Do you think when everything goes south, there might actually be finally a push for abolishing the Federal Reserve?
Well, I do know that throughout history in America, we've had 3 central banks. The first 2 disappeared for whatever reasons. In my view, this one's going to disappear. Mainly, the world has problems without a central bank. There's no question about that. We all have problems without a central bank. But we also have many times problems with central banks. And this central bank is making our situation much worse. As I said, they have quadrupled their own balance sheet. Their debt has gone up by 400% in just 5 or 6 years. They're printing staggering amounts of money. This central bank is going to make things worse for all of us in the end. Now, whether it leads to the disappearance of the central bank this time, I don't know. In my view, it will, because they've made such horrible, horrible mistakes. And the public or the Congress or somebody will throw them out, or they'll go bankrupt. I mean, their balance sheet is a nightmare. It's worse than Fannie Mae and Freddie Mac was once upon a time. Now, by the way, if I say they go bankrupt, they'll obviously be bailed out by the government, which is going to make us all worse off. But the government may close it down at that point. So, no, in my view, we would be better off without this central bank. In my view, it's going to disappear. It's going to self-destruct. And when it does, we'll all be better off. But the only reason it's going to self-destruct, Garrett, and be sure you understand, is because of the problems which they are bringing to all of us, which are going to destroy themselves and harm us a great deal.
Do you think that gold would be the area where, a lot of investors could find a safe haven? Do you think gold's going to go a little lower and then we can all be a buyer?
Well, I own gold, and I've owned gold for many years. I've never sold any gold. I'm not buying at the moment because I expect that there will be another opportunity to buy gold down the road. And if I'm right and if I'm smart enough, I'm brave enough, I hope I do buy more gold if and when we have a big correction in gold, or more correction, not a big correction, more correction in gold sometime in the next year or two. It traditionally has been a way to protect yourself. But Gareth, as you know, there have been times when gold has gone down a lot in world history. In the 1970s, gold went up gigantic amounts, over 40 times during that decade. But there were times when it went down as much as 50%. So don't think it's a one-way street. I own it. I'm waiting to buy it, but I'm not buying it at the moment.
Gotcha. As a small investor, and, is there something that we can look for that could trigger the next move? Like, for instance, once the Fed loses control of interest rates, maybe the 10-year pops above 3%. Are there any things like that we can just kind of follow on an everyday basis to kind of know, or is it going to be something that just kind of surprises us all?
I wish I was smart enough. It's usually something that surprises us all. If life was so easy, we could just, we can predict some things, but there's usually some surprises as well. I would certainly watch the things you're talking about, watch interest rate, watch the money printing, watch currencies, because some currencies are already fluctuating dramatically. That means if a currency goes down, somebody's going to lose a lot of money, just like if the currency goes up. Somebody's going to lose a lot of money because they're on the wrong side of the trade. So watch currencies, watch the state of the economy, watch for war. War is never very good for anything except commodities and gold. I'm not advocating you buy gold because of war, but I'm afraid we will have more war in the next few years. These are things to watch out for. And one other thing, watch out for panic in the precious metals markets. Also, panic for any reason at all. But if it does, I would urge people to think about buying at that time. It's usually, in my experience, if you find a market where there's panic selling, you probably should step in and buy if you know what you're doing, because panic selling nearly always leads to great opportunities. And if we can get some panic selling in gold, I hope I'm smart enough to buy a lot more.
Interesting. Now, I noticed recently that copper's really taken a big hit. Do you think there's panic in the copper market, that maybe it's getting near a buy point, or what's your view on copper?
Interesting you should say that. I have noticed, obviously I noticed what's going on with copper. I'm not sure it's panic yet. It's certainly making lows, multi-month lows, no question about it. I stepped in and bought a base metal index recently because of that. But I'm a very, very bad market timer, Gareth. I'm the world's worst trader. So please don't listen to me. If I buy it, you probably should sell it, at least in the short term, because I usually get it pretty badly wrong. But yes, I have started buying some base metals because I see what you see.
All right, yeah, interesting. No, I mean, I think many investors, including myself, would be more than happy to be able to follow you anywhere in the investing world. So,
but say that.
Do you have any thoughts on Bitcoin? I mean, is this just a craze, or is there something to this? I mean, is it being driven because of all this money printing that's going on, and people are kind of looking for that area where that may not happen?
Well, I'm embarrassed to say I never really bothered to learn enough about Bitcoin to make any decisions. People were always trying to explain it to me. And I said, it's too complicated for me. And I don't really understand it well enough to give you an answer. I can, as you point out, there are many problems in the world with money printing, etc. People are looking for something as an alternative to staggering amounts of paper money which is being printed, whether it's going to be Bitcoin or something like that.
Now, just as we wind down the interview today, I was just curious, what's next for you, Jim Rogers? I mean, are you working on anything at this point? Are there any things that you're looking to do?
No, I'm mainly, as I said to you earlier, I didn't have children until late in life, and as far as I'm concerned, my focus now, Gareth, for better or for worse, is my children. I came to this late. I got these two, what I consider wonderful little girls. So if you ask me, my next adventure, one little girl 6, and one is 10. And that's where I spend as much of my time as I can now. I obviously do other things, but if I had a choice of having dinner with anybody in the world, I'd rather be my two little girls, even than you, believe it or not, Gareth. So that's my focus going forward.
I can accept that. Thank you so much. Where can our listeners follow you or read about your views more so? I mean, if we want to kind of follow your insight and your kind of thoughts.
I have a website, which is not very... at least my official website is not all it gives is my public speaking schedule. There are websites and Facebooks and Twitters out there. They're all done by imposters. I don't have anything to do with any of them, but there are people who gather my appearances and then post them. I guess that's one way. They're supposed to say on them that these are not official and Jim Rogers has nothing to do with them. But, I mean, there's nothing I can do. If somebody just takes an interview that they thought I did and post it on a blog or a website, that's perfectly legal. So there are plenty of places on the Internet. I'm sure that this interview will be on the Internet, too, whether it's YouTube or Google or what. That's the best way I know going forward. You can read my books.
Absolutely. I was just going to ask you about that, in fact. I was going to ask you, as our listeners are listening in, if you had one of your books that you would recommend first for them to read, which one would it be?
Well, at the moment, I would probably recommend my latest book, just because it's my latest. It's called Street Smarts, Adventures on the Road and in the Markets, and it is my latest. It tries to wrap up a lot of the stuff that I've done in my life, things I've learned, mistakes I've made. I would start with Street Smarts, Adventures on the Road and in the Market.
Do you have any final views on the market or any views that you'd like to share with the listeners before we head off?
Well, just I'd repeat what I said before, that sometime in the next couple of years, or if not sooner, the world's going to face some very serious problems, and be aware of that. People who were prepared for 2008 did okay. People who were prepared for 2002 and the problems back then did okay. You just don't go blindly into investing, because especially now, because many things are near their all-time highs, I urge everybody to continue to be prudent with their money and to make investments, but be aware that things can go bad and will go bad, and be prepared.
Absolutely. Well, thank you so much for joining us today. It's honestly, it's a true honor to be able to speak with you. Thanks you again to Mr. Jim Rogers, great American businessman, legendary investor and author. And we look forward to seeing you on more appearances, and thank you again for joining us.
Thank you very, very much, Gareth. Let's do it again someday.
Absolutely. Thanks again. Take care.
Thank you. Bye-bye.
All right, guys, I'm back on here as we wrap the show up today. We have about a minute left, and I just wanted to briefly go over, first and foremost, say thank you again to Jim Rogers for his insight there. Great interview and really enlightening in terms of his views on the overall market in the coming months, in the coming years. Lastly, I just want to say watch this week. Overall, I'm expecting a little bit of choppiness with some potential further downside, although, again, I did give you levels on Facebook, Priceline, and the IBB Biotech ETF to be buys. And again, watch Monday night, big China economic news, and the jobs report on Friday should be both very polarizing events here in this coming week. This is Gareth Soloway from InTheMoneyStocks.com, and this is In the Money Stock Market Action on 820 AM News Talk Radio. Take care, guys.